Borrow die. Buy borrow die. Security-backed loan, line of credit, pledge asset, Charles Schwab. Margin loan, remember 3% rule. Let's say you have X capital. If market crash like 90%, you left 0.1x amount in capital. Let's say your brokerage allow up to 50% margin, so you will get margin call when your loan greater than margin limit. 0.1x multiply by 0.5, it is 0.05x. If your margin loan is less than 5% of capital, you are safe. In summary, stock market index crash worst at 90%, which happened 1929. It took 25 years to recover to pre-crash level. Let's say it did drop 90%. If you invest in index fund for long term, like more than 25 years, only take 3% of margin, you are safe. So risk is not the market risk. Risk is that you have no enough capital. If you have enough capital, 33-time annual requirement, take 3% from borrow money and keep investing in index fund. You can retire on your 3% loan with minimal interest, whereas your index give return as 10% per year in long term. My strategy heavily follows Peter Lynch, Andrei Kolosteny, Warren Buffett wisdom, etc. Study from different book, not limited to investment books. Take as pinch of salt. 10 to 20% content hold true for future. Apply it in your situation. Don't blindly follow. Books are great. You can learn whole experience of the author in one book. It is most worthy investment you can do in your life. In conclusion, buying good index fund is good strategy. I will say QQQ or other similar ETF, e.g. XLK 00757-7TW, 00662TW for Taiwan, 0P001M31S, BO for India, etc. Google similar ETF or fund in your country such as CDNX for UK, etc. I know Buffett mentioned SPY. But I think we depend on technology and future, be it autonomous vehicle, genomic technology, AI, blockchain. We should invest in technology-focused index fund instead. SPY will give you CAGR like 9%, 8% growth plus 1% dividend, whereas Core FANG index fund will give you CAGR above 10%. For a low risk-reward ratio portion, you choose stock or ETF you have conviction and are comfortable with, such as ARK ETF, FFND, Bailey Gifford & Co Growth Fund, etc. Bond, gold, fixed deposit / certificate of deposit is bad, bad, bad. Time in market better than timing market. If not, trader should be in Forbes list, not Warren Buffett. For good index fund ETF, it keep on rising average and long run. Be optimistic. Initially use lump sum investing LSI then dollar cost averaging whenever you got money, like salary and month end, etc., into index ETF. Let's say you have 100,000, 100K. Please do not split your 100K into 2K per month and invest for 50 months. Unless you are donkey, you should invest 100K as lump sum, then invest every month when your salary is an e.g. 0.5K 5K per month. It is DCA. Peter Lynch learned 10-bagger concept from his books. Know what you buy. There is no other formula. Do your own research. Bond and certificate of deposit or fixed deposit, never right way to go. Best stock is stock you like and stock you may already own. When insider is buying, it is good sign. Futile to predict economic and interest rate. Done time market, stock can go higher even it is new high, stock can go lower even it is new low. Buy business, not stock price. Before buying, you should be able to explain why you are buying it. Be optimistic. Andre Kolostany. Investment need money, extra money aside, emergency fund, luck, patience. Dog and owner, value of company is value, stock price is dog, no matter how far dog go, he will return to owner eventually. Egg theory, buy in bottom of egg A1 and B3, refer to YouTube video or simply Google. Warren Buffett. He did not publish any book, he shared his thought in letter to shareholder or meeting. I will not share most of point everyone know, I think a lot of us misunderstood him anyway. Diversification is protection against ignorance, aka put egg in different basket for those who did not study. Diversification is no sense for those who know what he is doing. Recommend that we invest in circle of competency, COC, but I feel we should learn beyond circle of competency. Nassim Taleb Charta book series, ESP Anti-Fragility, invest in something, risk-reward ratio low. Ray Dalio. All-weather strategy for wealth preservation. I personally feel that retail investor can practice it in less than 5% portfolio unless we reach that stage of billionaire where we need to do wealth preservation. Philip Fisher and his son Ken Fisher books. Importance of growth stock. Stock is safer than bond in long run. Retiree not need to be conservative. You can't achieve real growth in your portfolio without taking some risk with your capital. Take your calculated risk in your investing. One big bear and you're done is wrong. Over time, stock market surges will compensate for bear market losses. Lump sum investing results in higher returns 69% of the time. Other books. A Random Walk Down Wall Street by Burton M. Malkiel. Most Important Thing by Howard Marks. Answer to Investment by Gordon Murray. The Four Pillars of Investing by William J. Bernstein. Enough True Measure of Money by John C. Bogle, and so on. Free resource. YouTube channels: English Chicken Genius Singapore, Dave Lee Cafe Money Kelvin Learn Investing, Chinese Click. Invest for Freedom.